Good morning, everybody. My name is David Shields. I'm co-managing shareholder at Shields Legal. We are a boutique law firm that operates in North Dallas, just outside of Addison, for those in North Texas. We've been in business 35 years. We're celebrating that anniversary this year, which is obviously very exciting. For our entire history, we've really focused on middle market companies that are particularly, either family office or entrepreneur owned. We have 4 different practice areas. We have a cybersecurity and data privacy practice. We have a business tax and high net worth estate planning practice, commercial litigation, which is far afield from what we're talking about today. And then, of course, our corporate transactions, which includes our M&A department. We have 16 lawyers, and today we're talking about, we're talking about a subject that's near and dear to my professional passions, which is preparing companies for an exit. It's something that we've been doing for our entire history, 35 years. We have deep experience and lots of professionals that are motivated by helping people not just get to that exit from term sheet, but also do the preparation. Andrew, will you go to the next slide? Okay, so for now, that's a little bit about me and the firm, but let me introduce Michael Hannon and Marty Hannon, who will tell you about Marshall & Stevens and their background.
Thank you, David. We're pleased and honored to be joining you for this webinar, and again, to thank you to all of our guest speakers and attendants for making this possible. My name is Michael Hannon. I'm a chartered financial analyst and chartered alternative investment analyst. I've been in the valuation and transaction advisory business for about 6 years. I'm joined by Marty Hannon, Managing Director of Transaction Advisory Services at Marshall & Stevens. In addition to being in the business for more than 40 years, Marty is also a chartered financial analyst, the founder of ValueScope and other firms, and he happens to be my dad. By way of background, Marshall & Stevens is the oldest valuation firm in the United States, having been around for more than 90 years. ValueScope, Marty and I were previously with ValueScope, which merged with Marshall & Stevens in 2024. And now the combined company, we have the resources to be a full service valuation, appraisal, transaction advisory services, litigation support, and investment banking firm. Shields Legal Group and David are great partners of ours, and they have a phenomenal team with great breadth of expertise. Marshall & Stevens and previously ValueScope have worked with Shields Legal and many members of their team, and they are a very valued partner.
Yeah, I couldn't agree more with that, Michael. Thank you.
Awesome. Andrea, could you go to the next slide, please?
And please don't hold against Michael that I happen to be his father.
So Marty and I will be discussing various topics that should get you thinking about how to harvest maximum value for your business. We'll be discussing fair market value and how it's determined in transactions, key valuation drivers and deal implications, and value creation. Then David will take over and talk about the growth to exit strategy, transaction readiness, and legacy protection. Andrea, could you go to the next slide, please? So when we think about value, there's an important distinction to make between equity value and enterprise value. Equity value is what business owners typically care about most, as it's the value they would receive from selling their business, and it doesn't include any interest-bearing debt. Enterprise value, on the other hand, is a measure of a company's assets and is useful for experts to compare businesses with different levels of financial leverage. And any excess cash held in a business is typically excluded from enterprise value, as it would be distributed to a seller prior to closing on a sale. Andrea, could you go to the next slide, please?
Hey, Michael, let me make a quick comment about that lower left-hand section. That intangible asset box is actually distorted some because in reality, about 92% of the S&P 500 value is intangible assets. That has grown markedly over the decades. It represents, of course, patents and data software, brands, trademarks, copyrights, customer relationships, and goodwill and organizational know-how. So, with the advent of the service economy, the internet, and of course now AI, that intangible asset percentage as a percentage of the total asset value of companies has grown substantially. Thanks, Michael.
There are multiple levels of value for a security interest in a company, depending on the level of control and marketability held. The factors that influence control and marketability stem from the ownership structure, operating agreements, and sometimes just the economics of the industry in which the company is in. Discounts for lack of control may be applicable to minority interest, and discounts for lack of marketability may be applicable to minority interest in private companies or in restricted securities.
And while it's important to understand these concepts in a deal framework, of course, these issues are of significance, very much of significance in an estate planning context, which involve family transactions in support of typically lower gift and estate valuations that obviously David mentioned. Part of his business involves that as well. Next
Andrea,
slide.
can you go to the next slide, please? There are three generally accepted and conceptually distinct approaches to determining value. The cost approach is an adjusted balance sheet method. The income approach is a discounted future cash flow method. And the market approach is a market comparables analysis. Valuation analysis, as well as financial forecasting, can be performed from a top-down or a bottom-up perspective. A top-down perspective starts with the overall economy and ultimately relies upon company market share assumptions. And a bottom-up approach utilizes company-specific metrics such as price per unit and number of units sold to determine the forecast. Andrea, could you go to the next slide, please? Normalizations are adjustments to company financial statements to reflect their true economic performance. There are multiple ways owners can there are multiple ways to increase reported profits prior to a sale, and while some adjustments are downward, many of them are upwards to the benefit of the seller.
Now, that said, there's going to be a lot of buyer scrutiny typically on any attempt to add or quote adjust to reported profits, especially since now add backs have been substantial. There's been a recent study that shows that 30% of adjusted EBITDA is now based on these add backs, and that was just 10% a decade ago. Next slide, please.
Typically, when we think of a sale, we think of an enterprise sale where an outside buyer comes in and acquires the whole company. However, we see scenarios where a second generation buys out a first generation in a management buyout, or a recap transaction where a company takes on additional debt or equity capital and a special distribution is made to the current owners. The type of transaction typically is dependent on the owner's goals, and it doesn't necessarily require the loss of control.
And just, Michael, by way of example, we had a long-term client who did a leverage recap, and we pulled $15 million by getting some bank debt out of a company that had an asset value of about $60 million. And we were able to do that by demonstrating to the bank that there were no valuation, debt coverage, or solvency concerns. Next slide, Andrea. Thanks.
Sellers should understand the type of buyer they're talking to. Different types of buyers may have different goals with the company after acquisition, and therefore they may perceive the value of a company differently.
You know, it used to be that a corporate strategic buyer, as probably many of you know, often paid the most, but that price differential has vanished in a lot of industries with so much private equity dry powder that needs to be deployed. And that buyer competition has in part allowed for some of those add backs to be excessive at times. Next slide.
Companies can be purchased via stock or asset purchase. Stock purchases involve the acquisition of the outstanding stock of the company, where a buyer comes in and assumes all of the assets and liabilities. An asset purchase involves the acquisition of all or certain assets of a company, and the current ownership maintains the outstanding stock after the sale. The type of transaction is typically dependent on the type of buyer, but also just depends on the circumstance of the transaction.
Now, this chart is likely quite representative of most typical transactions, but needless to say, a buyer should almost always want to sell stock to avoid most future corporate liabilities. And I know David's going to get into some risk mitigation in his segment as well. Next slide, please.
So how should sellers view the types of deal consideration? Well, cash is, of course, generally the most desired. Rollover equity and buyer stock are great ways for sellers to maintain risk and reward in a company going forward and to have the opportunity for a second bite at the apple. Earnouts are generally not loved by sellers, but they're a wonderful way to bridge a valuation gap between a buyer and a seller, and they allow the seller to maintain upside over time. Seller notes depend on the preferences of the seller as well as the risk in the note itself. Very circumstantial. And the same goes with employment agreements, where it depends on how the seller wants to stay involved in the business after closing on the transaction. And sometimes buyers require sellers to maintain the business for a certain period of time to kind of transfer over. But generally speaking, employment agreements can still be a great way for additional income.
Now, these are, of course, all important factors for buyers and sellers to consider when coming to the terms of a deal, because they affect value, liquidity, and risk. And none of these things are mutually exclusive. It's the optimal mix that creates the perceived strategic, lifestyle, and economic win-win that allows deals to close. Andrew,
Marty,
next slide, please. Yeah, go ahead.
Before we go to that next slide, we're seeing in our M&A practice that, sometimes a lot of these deals have 3 or 4. Andrew, do you mind going back real quick? Just put that back, that one back up there. We're seeing 3, 4, certainly 3 at a minimum, sometimes all 5. What are you guys seeing in your kind of side of the world?
Yeah, that's a great question, and it's a great way to close the gap, right? Especially when there's differences in perceived risk. There's asymmetry between buyers and sellers. So for instance, if the buyer doesn't agree with the forecast necessarily, more money might be pushed into an earnout, or an earnout might be created as a result. So you're right. I mean, it really, the flexibility of all these components allows deals to close more effectively. We are seeing multiple components in most deals. Less than half, I would say, are all cash.
Yeah, for sure. I echo that, for sure.
Often there is time to plan for a sale of a company, and there's tremendous value in proper planning for the transaction. An ideal situation for value creation involves scaling the business to grow both EBITDA and the multiple received on EBITDA while improving efficiencies and de-risking the business. This can allow for tremendous value creation in a relatively short period of time. Andrea, could you go to the next slide, please? This equation shows 3 paths to organic value creation. Path 1 is to increase cash flow from existing assets and operations. Path 2 is to reduce the company risk and optimize the capital structure. And path 3 is to increase the growth rate of future cash flows.
Yeah, in theory, buyers pay for the future cash flow of the business at a hurdle rate or a risk-adjusted discount rate. But in practice, this often translates to a multiple of TTM, trailing 12 months, or current EBITDA being a proxy for cash flow being the true economic measure of value. So paying, for instance, 7 times EBITDA means that a buyer is valuing $1 of current cash flow at $7, but it really represents the present value of all future cash flows. And while many transactions for small companies might trade at a, say, 5 to 8 times multiple range. Some companies sell for huge multiples. From this equation, you can see as the growth rate approaches the discount rate, the multiple can be very large. So growth rate is very important. Now that said, growth and risk are often related. So usually both are very high. Think tech company. I say both. I mean discount rate and growth rate. Discount rate reflecting the risk of the forecast and the risk of future performance. Or they can both be low. Think mature, stable company. Next slide, please.
There are multiple ways to grow cash flow before a transaction, and these key metrics can be reviewed well in advance of a sale. And they include the optimization of high margin products and product pricing, working capital optimization, and the reduction of customer concentration risk, and capital expenditure optimization.
Alternatively, when advising on the buy side, one needs to understand what profits are likely in the near term, given the for instance, recent profit growth, and what's sustainable. That's really key. For example, might profits in the next year or two fall because there are capacity constraints? Capacity might be insufficient because of recent growth. So there's many, many issues to consider whether you're on the sell side or the buy side. Next slide, please.
Successful acquisitions allow owners to compound value by growing EBITDA and earning a higher multiple on the combined business. In advance of a sale, sellers can employ this buyer strategy to acquire EBITDA at a lower cost than can be realized in a subsequent sale. This can also diversify the company and reduce its perceived risk. Next slide, please.
Well, this is the concluding slide. Thanks, Michael. And before turning it over to David, this just shows our list of services that pretty much covers all the bases of transaction planning and execution, from valuation to transaction advisory to investment banking, which is performed by MS Capital, which is part of our company at Marshall and Stevens. I know David will talk a lot about pre-sale transaction readiness, and that often involves quality of earnings analyses, which we do quite a bit for, mostly on the sell side, but quite a bit on the buy side as well. So needless to say, now's a great time to be planning and for the execution of a sale. Valuations are quite high, as everybody knows. All you have to do is look at the stock market. It seems like, and although private multiples, of course, a lot more sticky than what's going on in the S&P 500. It seems like any news is good news when it comes to the public markets. So, David, do you want to take it from here?
Sure. Thank you, Marty, and thank you, Michael. And I just want to echo, I appreciate what you said about our two firms' close relationship. It's a 20-year one, and I really appreciate what you guys did and what you had, and the opportunity to work together again. To those attendees, thank you for being here. Like I said, this is a very sophisticated series of discussions, very important discussion for a lot of entrepreneurs and business owners, because most people spend 10, 15, 20 years, sometimes more, building their business, and they only get the opportunity to sell it in a big way like this once. So in addition to being a really complicated and complex discussion, it's an important one. And you can see here, just very briefly about our growth to exit strategy. We are our corporate transactions team. We are an M&A team, which means, to me, that means we help structure the transaction at the term sheet side, and then take over after a term sheet, negotiate with the buyer, assist with the diligence, finalize the documents, get the language, and then close the transaction. In the growth to exit program that we've kind of created based on our experience is really a pre-sale, pre-term sheet, sale preparation scope of work that leverages our experience as M&A counsel to really do a lot of the prep work ahead of time. And what we've seen is that opportunity of 6 months, 12 months, sometimes 2 years, sometimes longer than that, to prepare a company for an exit transaction really puts people in that 20%. So, Andrew, would you go to the next slide, please? So just very quickly, for those that have not been through the exit transaction or even the purchase transaction, as an entrepreneur or even an officer in charge of a department or a COO or a CFO, to those that are on, you really have three jobs when you're in the midst of an exit transaction. You have to do the diligence, which is an incredibly more than a 40-hour a week, incredibly time-consuming job. You have to deal with your advisors in negotiating the transaction, its structure, the language, the earnout mechanics, and you have to model it and deal with your working capital. And you have those two are big jobs, both full-time, sometimes more than full-time. And then you have to run the business. I mean, that really gets lost in a lot of this exit, in a lot of these exit transactions, about how much time it takes to do the diligence, coordinate the negotiation, and still make sure that the business doesn't just not fail, but continues to succeed. And so our sale preparation process really tries to prepare companies, not just the individual owners, but prepare the companies from an organizational structural standpoint to try to eliminate one or two of these jobs, because really at the end of the day, it protects against that seller fatigue. And, if you define seller fatigue as the entire team is working hard, you're pushing towards a close, and in that last 2 or 3 weeks, the buyer comes with some sort of retrade. Some of it may be legitimate, some of it may be not. I've seen sellers say, well, I know that I deserve more, but I just, we're going to give up on that because I want to close the transaction. And what's interesting about seller fatigue is there is no opposite. There is no buyer fatigue. I've only been doing this 15 years, but I've never heard of a transaction in which a buyer was so involved in the process and frankly fatigued by the process that a seller said, we want to increase the purchase price. And the buyer says, oh, you know what? I'm tired. Just give them what they want. Never seen it. So the growth to exit, the sale preparation scope of work and that process that we walk these companies through is really to protect at its core that asymmetry of seller fatigue. Andrew, we go to the next slide. So the first thing that we do is try to identify and protect against these structural issues. There's probably 100 of these, but you see a couple examples on the screen. And we do that by really running the company through an actual diligence process well before you do it, a live fire exercise with a buyer. And so what that process is, we will take because the M&A team does buy-side work as well, does buy-side representation as well. We'll use an actual live diligence list, provide it to the client, and then build the data room. Go find the HR policies, go find the payroll records, the accounting statements, the tax returns, the insurance, responsive insurance information and documents, and we'll build that into a data room. And while that's happening, we'll go through and conduct a little bit of a review to see if there are any of these kind of top, retrade trigger issues that can be cleaned up. So the process is, let's do as much of the diligence as we can ahead of time and identify issues that we might be able to take and fix ahead of that term sheet. Sometimes that process, like I said, takes 2, 3, 4 years. Sometimes, clients come to us and they say, we want to start the sale process in 6 months. What can we do? And so it's a very kind of flexible scope of work and very much depends on the client, but it is focused on transaction readiness by trying to eliminate, one, maybe 2 of the 3 jobs that or roles that companies have as they go through the sale process. Andrew, will you go to the next slide? So what we do from a transaction readiness standpoint, our kind of internal KPI is 80% of the non-accounting diligence is complete before the company goes to market. And the reason for that is, if you think back a couple slides before, you see that you haven't fixed all the diligence, far from all, but you've really the dredge, the hard work of collecting and organizing a lot of the diligence information. Some of these diligence lists can have 500, 600, 1,000 requests. And if you get through, a couple hundred of those, you've made material progress in preparing yourself for for a potential exit, and you've given your advisors, your attorneys, your financial and accounting advisors like Marshall and Stevens, your tax advisors, your estate planners, you've armed them with the information necessary to actually do some improvement based on their experience. So you can kind of see here a little bit about how our process works in phase one for transaction readiness. Andrea, can you go to the next slide? So the next thing, once you have done kind of phase one, you've built a data room. We've gotten to that internal KPI of 80% of the non-accounting, non-financial diligence is collected in a data room. That data room could have hundreds, maybe thousands of documents in it. From a preparation standpoint, that process can take a couple of weeks, a couple of months. You now have the ability to take that universe of information, how their business is presented to a buyer, and arm your advisors with that information. So hopefully as part of the sale process, you've been introduced to an investment banker or a business broker that's really done the, kind of the right preparation, that's been in the experience, that's done deals, that knows your potential buyers, that knows the universe, and knows the items that you need, that a company needs to think about while you go through the process of the sale process. So you have your team is typically made up of the four things you see on your screen: an investment banker incentivized to close a transaction, a financial and accounting advisor, somebody like Marty or Michael at Marshall and Stevens, your legal counsel, and then your tax counsel, because obviously, I think everybody knows that minimizing taxes is kind of the name of the game, not at any cost, obviously, but there are a great many ways that structuring a transaction can be done in a way that's more tax efficient or more or less tax efficient. So having that tax advisor in there is a key part of the team. Andrea, can you go to the next slide? Okay, so just real quick, sometimes you want to have a quick sale, or you want to engage a business broker to, like Michael and Marty talked about, to actually bring you acquisition candidates as part of your growth phase, a couple years prior to an exit. But I really wanted to have a quick discussion about the difference between our supposed difference between a business broker and investment banker. So what you're really looking for as part of the exit process is finding somebody that traditionally is incentivized to close the transaction by getting a contingent fee, typically as a percentage of the value. And you'll see, sometimes one's appropriate, sometimes another's appropriate between a business broker or investment advisor, or an investment banker, excuse me. But what you really want to know as part of your team is this is the role that's going to bring buyers to your company. They're gonna scope them. They're gonna talk to them. They're gonna help negotiate the business and financial terms of the LOI. And the biggest thing to look forward to is whoever you pick to help shepherd and bring those buyers. You want to make sure, if you're going to go through the sale preparation process, you want to make sure that whoever that is, they're knowledgeable enough to know the non-financial. You just heard a great presentation by Michael and Marty about the financial and accounting portions of your business that increase value or affect value. You want to find somebody that has done a bunch of these sales in this industry and kind of knows the non-financial drivers of value for your business. And I'll give you a quick example. Several years ago, probably 10 now, maybe a little bit less, we were working with a company that had 4 or 5 offices in the state of Texas, and they wanted to go through a sale process. So we found an investment banker. We interviewed a couple of those investment bankers, and I or the company asked the same question of each one over and over again, which is what non-financial, non-accounting aspects of the business increase value. And one of them happened to say, I've sold a business just like yours. And I've sold a couple of them, and I noticed that you get an extra turn on EBITDA or an extra half turn, a 10 or 20% lift just for being multi-state. All this company did was go to the edge of Oklahoma, open an office, invest, $100,000 in 6 months so they could go to market as multi-state. And it was a little bit more complicated than that. But just as a general rule, you want to assemble that team that knows not just the financial levers that increase value, but those non-financial levers. Andrea, can you go to the next slide, please? Okay, this is kind of my wrap-up slide because I want to make sure we stay on track for timing here. We will be doing more webinars in the future that are not just about preparing your company and selling your company, but preparing the entrepreneurs and the owners that are going to result from this kind of liquidity event. There's many different aspects to it. In addition to M&A counsel and sale prep counsel here at Shields Legal, we also have a tax and high net worth estate planning team. So we'll be here to talk about that in the future. Andrea, can you go to the next slide, please? Okay, now I'm going to turn it back over to Michael and Marty to have a quick conversation with their guest.
Thank you, David. Is Maury online now? Andrea, do you know?
I don't see him online.
Okay, John, we'll kind of switch here, Marty. John Jackson, are you available?
He is available. Let me permit him in.
Okay, John, good morning. Are you connected? Can you hear us? Might be on mute there.
Yes, let me.
Can you? Yeah, there we go. Sorry about it. I'm not in my office today. How are you?
Doing great, John. Thank you for joining us.
Good.
John, just wanted to take 5 minutes real quick. You are actually a client of both Shields Legal and Marshall and Stevens. We helped you kind of through your process to sell your business, and you were, you trusted us, I think, with a pretty decent chunk of the entire process. And I know you probably recall this, but we started at the beginning. Do you mind sharing just a few words about where you were in the exit process just when we got introduced?
Well, I have some very good friends that had been through the process before. And, when I was just in casual conversations with them, when I mentioned that, I was starting to look for, implementing some kind of exit strategy, they advised me, they said, you need to get some help on that. It'll relieve a lot of stress. It'll do all this good stuff if you'll get a good advisor right at the beginning. So that's kind of what we did. My friends were out of state. I had just recently moved to Texas over the last 10 years. And so I went through some of my network of friends, my local friends, and that's how I hooked up with David. And yes, you did. You helped me through that entire process. It was very, very good.
Yeah, and John, my recollection is, and you may know better than me, but my recollection is that process took about a year. I think we were engaged in March. Yeah, January, February, March of 24, I think.
Right.
We spent the first couple of months collecting that diligence, working through the list, really bugging and pushing your team to get us everything we needed. And then we interviewed some investment bankers and business brokers you selected, and then it was off to the races. Can you kind of elaborate on that from your perspective?
Yeah, I had thought at the time that I was somewhat prepared. I kind of went into my business knowing that at some point I'd be doing this. And so, I thought I was fairly well prepared for it. But the process, when you guys started setting up, our data room and really helping us start getting all of our documentation together, to my recollection, I mean, it really took us, several months to get what I thought was already kind of clean. It took us a while to really get ready. I realized how short we were on a lot of that stuff, but we did. You guys helped us get through that. I had people in our organization that they were pretty much assigned to, coordinating that with you guys. And then once we got the broker, and my plan was to, sell the business maybe in, 26, 27 timeframe. And, we got looking around at a lot of the things that were going in the market, and we decided, especially in discussions with with all of our team together, it's like would be a good time to sell. Here's so we actually moved our clock up a bit and closed a year ago this week, actually.
That's right. Well, John, I don't want to share too much confidential information. I want to make sure that we're not sharing too much. But you sold to a strategic, meaning the buyer that you sold to was somebody that was already in your business. How is that kind of just very very briefly, very high level? How's that transition gone? Do you feel like you were prepared for it?
I was, and just because of my, prior experience in my career, my expectations were not really high, because I've heard all the horror stories, but it's gone very well. I really enjoy the team I'm working with, and they've been very good to me. It's been good.
Awesome. Well, thank you, John. I know you got to get on with your day and stuff, so we will thank you for your time, and we're going to move on to Maury. Thanks, John.
You bet, Dave. You guys take care.
Thank you. Okay.
So apparently Maury's not able to join online for some reason. That's what happens when you do a migration at the exact same time as a webinar. But I've got Maury on my landline, and I wonder if you'll be able to hear him. Maury, can you hear me?
I can hear you fine. Can everybody hear me okay?
Yeah, it's okay.
Okay.
Yeah.
Well, we're going
great.
we're going old school here. Probably not many people.
Yeah, there we go.
Not many people with landlines anymore, but we'll try and make this
Yeah.
work. I'd like to introduce Maury DeZara, who is the president of Luna Carpet, which is based in Chicago. That company was sold to Empire Today. Now, many of you have probably heard of Empire Today since they do a lot of TV advertising, especially. And both companies are shop-at-home flooring companies that originally competed directly in the Chicago market, but Empire was in dozens of markets. Maury is now the president of Scale Marketing, and I'll let him describe that a bit at the end. But we helped Maury with a very important transaction years ago. And Maury, let me ask first, what was the strategy to sell to Empire Today, which was your main competitor in the 800-pound gorilla in that market?
Well, Empire got bought out by private equity in the late 90s, and that firm took Empire, that concept of shop-at-home flooring across the nation. They opened up, I believe, in 70 markets across the country. And so we competed directly with Empire in Chicago proper, where we're headquartered. And we knew if we wanted to get a premium value, Marty was on our board, and management and Marty together decided that the best path to a premium value would be to expand outside of Chicago to take market share away from them. And so that's what we did.
So Maury, why couldn't you just sell on the basis of a multiple of EBITDA like so many other firms do?
When I came into the company out of college, we were doing only like $1 million in revenue. We kind of grew it in the Hispanic market and then grew out of the Hispanic market into the English language market. And the company got up to about 40 million of revenue in the Chicago area. But we were always focused on growth. We also knew if we were going to do geographic expansion, you just have to invest in human resources and technology to be able to do that. So our EBITDA was always kind of depressed because we just were plowing all of the profits into future growth. So looking at a historical EBITDA, would not have given us the valuation that we wanted at exit.
Yeah. And so would you consider what happened a successful transaction?
Very successful. So, you know, in 09, that's when we were at around $40 million in Chicago. And that's when we decided to expand geographically to compete with Empire on a national scale. So we opened up Baltimore in 2009. We opened up Milwaukee in 2010 as a spoke and wheel to Chicago. And then in 2011, we opened up Boston and DC. And that really got the attention of Empire because they understood that we were a formidable competitor, and it was really a defensive move on their part to reach out to us.
So connecting the dot to what David said a little earlier and getting lift in multiple as he had a client expanding to another neighboring state, what was the valuation modeling and negotiating strategy that was employed to get the highest possible price at exit?
Well, Marty and his team built out really a pretty elaborate model that kind of proved out the deterioration of value of Empire as Luna continued to expand. So basically, when we would open up, and this is back, you know, we're going back a few years here, but, you know, us and Empire were really the only ones in the shop at home carpet space. This is back in the, you know, early O's going into the, you know, the 10s. And so back then, carpet stores were still a dominant way to buy, but we were competing with them head to head. And so we were really in the lead generation business. And so when we would enter a market, what would happen to Empire is their lead costs would go up, their conversion rate would come down, and their transaction size would come down because now you've got a competitor, so you can't charge what you used to charge. It used to be more monopolistic before Luna entered a market. So what Marty and his team put together was, you know, while we might have been in 5 markets at the time of exit, we were going to add 1 to 3 markets a year. And so they put together a kind of like a pro forma, what happens if we continue to grow and the deterioration of value at Empire. And that, I think, really drove the conversation around what was a very, very premium value for our firm.
Yeah, interesting. So that's what you get when you do a lot of economic loss and litigation support work, which we do as well. So we kind of tie those two together. So Maury, it sounds like it was a classic strategic acquisition then, right?
Beyond classic. I mean, this was like the perfect storm. It was a really, really wonderful exit for us.
Hey, can you tell us a little bit about scale marketing and what you're doing now?
So scale marketing, so interestingly, you know, I had been in the flooring business for most of my career. After we sold to Empire, we became really expert. You know, we really felt at Luna that we were in the lead generation and sales conversion business. We sold flooring, but it could have been roofing, it could have been windows, it could have been pest control. Really, we were experts at generating leads at an efficient cost and had all kinds of metrics around closing deals. Of course, the carpet has to go in, you have to make the customer happy, but it was all about the front end. And so, you know, we had an iconic brand in Chicago in those markets where we opened because we spent tens of millions of dollars of our own money advertising and grew a very successful company. And that resonated in the middle market. So now I have an advertising agency, a performance marketing agency that serves the middle market companies, basically B2C firms that are between $50 and $500 million of revenue. And we develop the marketing strategy and we execute on the plan. And you know, what started as just me and my CMO back in 2014. Now we have over 70 employees, and we call it dollars under management. We are responsible for over $150 million of our clients' advertising dollars. So it's been quite a journey.
Maury, you're obviously 2 for 2. Fabulous success. Thanks so much. Stay on the line for a few minutes if you don't mind, in case there's a question. Yep. David, you want to take it from here? Hopefully you're able to hear Maury okay?
Yeah, no, it was great. So we want to open it up. Andrea, we go to the next slide real quick so we can wrap up right before the Q&A. So after this, everybody that registered is going to get a couple of materials from us. The main thing is what we call the advisor interview cheat sheet, which is you know, a very, very short kind of interview script know, to arm yourself on how to interview and select your transaction advisor, that's that investment banker or business broker. Andrew, would you go to the next slide? So here's a little bit about your three presenters, myself, Michael, and Marty. We are going to turn it over to the Q&A right now. We do have some discussion going on here in the meeting chat. The first question that I see here is by EJ Yannick. It's what % of earnout arrangements actually result in cash to the seller? I know that I certainly have some thoughts on that, and Michael and Marty, I know you will too. Do you guys mind if I go first?
Please.
Okay, great. So, you know, earnouts are the trickiest part. They really are. They are the value bridge in an exit transaction, but they're the trickiest part to negotiate. Definitely, there are scenarios in which sellers may not actually make the earnout, but if you have really good financial and accounting advisory help, like Michael and Marty, and good legal help, which I would say that that includes us, then you can negotiate all the language, and there's pages of it that go into that earnout calculation. And in my experience, the only earnout that I've seen in the sell side in the last couple of years that probably didn't hit at least a little bit of it was a large restaurant sale that we did that closed, I think, in March of 2019. Obviously, COVID hit and everything shut down 9 months, or about 11 months later, about a year later. And that obviously tanked the earnout on that particular transaction. But other than that, we see it fairly often because we really, in combination with firms like Marshall and Stevens, we really dive into the details and the definitions of working capital and EBITDA and add backs and build those schedules and have a good understanding of how the business is going to do. Michael, Marty, any thoughts on that question?
Well, I'd add to your comments that, determining that forecast is really critical especially if you're doing sell side representation, because we want our client, the seller, to hit those metrics, and often earnouts are capped, so we'd like them to hit the cap, and that has happened quite a few times. There's been a couple of situations I can remember that are high risk, high growth, where it's more or less perceived as gravy, where none of the earnout was hit, but in most cases, in my experience, part or most or all of the earnout is hit. Sometimes earnouts aren't even capped, but most are. So, what's the threshold of the earnout? What's the cap of the earnout? What's the share that the seller's getting? What's the metric? It's typically EBITDA based, but, be careful, as David's pointing out, because, the buyer's going to want conceivably to have all sorts of corporate overhead allocations and, be involved in integration and all that stuff. And that could really affect EBITDA. So yeah, earnouts are dicey. You have to be really careful from a legal perspective of how they're structured, and careful from an economic perspective that you believe that those forecasts are going to be achieved.
Yeah, and one last comment on that. We have another question here from Faye, and one other comment on the earnout is it really starts at the structure, at the term sheet stage. If there's every buyer wants to get a better deal. They're obviously incentivized, even though everybody's kind of working collaboratively to get a transaction over the finish line. The buyer's obviously incentivized to cram the terms down, cram the valuation down, get the best terms that they can. And so an earnouts, we see the buyer retrade, and we do the buyer retrade on the buy side on those transactions. But the buyer retrade typically comes in the form of, we know that we told you we were going to pay you X for your business in cash with a little bit of rollover and maybe a short seller's note. But it turns out that your financial performance wasn't quite where we thought it was, so we're going to do a portion of the earnout. So from a structural standpoint, there's I don't even know, a dozen or so different triggers that create that earnout. But one trick to do that on the sell side is say, okay, we'll do that. We'll convert a portion of our cash to an earnout, but we want 50% more. Mm-hmm. We want, to Marty's point about a cap, we're not just going to turn the cash consideration that you told us and have to earn that. We want the opportunity to earn more. And that's a big, big part that can, that when negotiated right and structured right, that can actually be a lift for the seller, which is the buyer's worried about value. And if you exceed that value, they're going to pay you a little bit more. So Michael, Marty, do you guys want to take the next question we have here in the chat about the stock versus asset sale?
Michael, do you want to comment first, or do you want me to? Yep.
I'll just add one more thing about earnouts first, then
Sure.
Marty, I'll let you answer the next question if that's
All right.
okay. So just so everyone knows, so structurally an earnout, there's a few key terms of an earnout, and one of the ones that seems to be asked about is the target itself. So the target of an earnout is the metric that has to be reached for a payment to be made to the seller. And so we those can be structured with revenue, gross profit, EBITDA, cash flow, or if the buyer is a public company, it could even be a stock price or share price. And so that's just only one component. And then there's the consideration as well.
Yeah, it looks like there's a question. Okay, stock versus asset. And I'm not a tax attorney or a tax accountant. And David, I remember maybe you probably have a tax expert on staff, but you know, and I don't play one on TV. So I want to be careful not to give any tax advice here. But, you know, the basics are, of course, if you sell stock, you're going to pay cap gains. And if you're an active owner, you're not going to pay, you know, Obamacare tax. Now, the bad news is if you happen to be in California, you're not only paying 20%, but you're paying their 13%, you know, at the highest marginal rate. So you're really paying 33% cap gains tax on a transaction in California versus 20% in Texas. So, you know, typically you want to sell stock to get the best tax treatment. There could be all sorts of other tax triggers when you sell assets. And of course, just limit the liability. You want the buyer to step into your shoes. They're assuming the go-forward liabilities. The seller's going to want tail insurance so that if anything happens on a go-forward basis that was a function of what happened in the past, you're covered. And I mean, David, you want to comment from there?
Yeah, you know, I would just say there's a couple of principal things that drive the asset versus stock sale. The first really is taxes. You know, in an asset sale, you know, particularly a business that has a lot of heavy assets. And by the way, as a disclaimer, I'm not a tax attorney. I don't play one on TV. We do have two tax attorneys that deal with these types of issues all the time. But I will just say the principal driver is going to be taxes, because if you do an asset sale and you've taken depreciation on those assets, there's going to be recapture at ordinary income rates, which cause, you know, which can be you know, can be material and are definitely a difference for stock sales. I will say that the conventional wisdom really is do an equity sale or a stock sale of your business, because you get that 21% cap gains rate on just really the amount of the consideration that you get. But Jack Ferris, who I know and is a friend of the firm, just mentioned that there are various other types of structures, including a subchapter F reorg, that buyers will ask for that effectively treat a stock sale as if it was an asset sale, because buyers get, I'll just say, favorable tax treatment for doing asset sales for a variety of reasons. And one thing that I would tell you or one thing I would tell everybody here about a stock sale versus an asset sale, it doesn't really come up a lot, is when you do a stock sale to a buyer, the buyer's buying every liability, and sometimes that's litigation, sometimes that's, you know, employment issues or whatever else. A lot of times you can insure around that. The one thing it's very hard to insure around is a buyer's buying your tax returns and your tax treatment. And so going all the way back to one of the first couple of slides that Marty and Michael talked about, if you have a bunch of those add backs from your ownership that you're running through stuff that is tangential and helps you from a tax perspective, the buyer's inheriting your tax returns. And so the diligence and the reps and the indemnifications and the potential tail liability of your past tax treatment goes with that. And that can be a material distraction. I'm not saying that it's worth that difference of ordinary income of 37% and 21% or 24% capital gains rate, but it gets lost in a lot of these discussions, because the sell side and buy side diligence on reviewing 6 years of really complicated tax returns can be a material distraction for the transaction, which is why, though you might get a good tax treatment for selling your equity, it can come at a cost, and that cost is time and money on the diligence side.
Absolutely. And connecting a couple of dots, you know, that when you talk about that reorg, where buyers are treating stock sales as asset sales, they get to step up the basis of those 92% intangible assets that we talked about before. So there is a big tax advantage to the buyer.
Yeah. We have one last question from looks like Dina Schaffer about valuation discounts for non-marketable minority interest. So first off, let me just plug Marshall and Stevens real quick. Marty, Michael, and their team are just experts in this and getting a really good valuation for and really working through these issues. And Marty and Michael, I want you guys to have the opportunity to talk about that in the last few minutes that we have. But I will just tell you, to the extent that question is, you're preparing for a sale, you have some minority shareholders that are former employees, current employees, a minority investor from before, and you want to make them an offer that recognizes their minority discount before you exit. That is that is a very complicated set of circumstances that does not lend itself to just putting the numbers in a calculator or spreadsheet and deal with. We've dealt with those issues. I'm actually dealing with one right now. But that is as more interpersonal, relational, legal rights, legal duties and obligations than it is just, what percentage are we going to knock off for you having a non-marketable minority position?
Yeah, it depends on the context of this question. You're absolutely right, David. I think the scenario that you just described is a lawsuit waiting to happen, which maybe is a good thing for your litigation team. You probably want to do this before an LOI or, before you even get close to an LOI, if that was the motivation. But this comes up a lot in estate and gift matters. And the two classic discounts, of course, are lack of control and lack of marketability, but it depends on the underlying assets. If we're talking about operating companies, which is the focus of this discussion, those discounts can be substantial in a general FMV context. If it's marketable securities, of course, it's a lot less. If it's real estate, it's somewhere in between typically. I don't know, Michael, do you have anything to add?
Yeah, so I mean, the way that we determine them will be through a custom restricted stock study. That's generally how we come up with a marketability discount. And so we'll perform that. We'll take into account the terms in the operating agreements. Those can all affect it. How restrictive really is that security? What kind of transfer restrictions are there? And then the other thing is just to kind of go back to what David and Marty were saying is if this company is about to sell, then it could be perceived that the minority, that the marketability discount would be minimal because it's about to exit, there's about to be a liquidity event. And so therefore it is quite marketable. And so, we can see the range of marketability discounts based on the expected holding period of the underlying security.
Great point.
Okay, well, we want to keep to the schedule here. Thank you, everybody, for joining us. We're just a minute or two over. Really appreciate everybody's time and attention. You can see our contact information for myself, Michael, and Marty up on your screen here. Please let us know if there's anything that we can do to help support anybody on the call.
And thanks to Maury and all the attendees and other guests. Thank you.
Thank you.
Thank you. Everybody have a good day. Take
Bye-bye.
care.